About 3 months ago, Tom Lee said this.
Doing a bit better. What areas do you see that have potential?
Well, I think investors in the next 12 months are going to start to say, what things get fixed if the Fed just stops being so aggressive on rates, right? So if rates fall, and it makes a lot of sense that asset quality gets better if rates fall for the banks, commercial real estate comes back, small caps, which are highly levered or higher levered, really benefit. So to me, this, the next 12 months, it seems like small caps can be up 50%. The Russell 2000 just crossed 2,000 today. So maybe
50%.
Yeah, so it could be Russell 2000 hitting 3,000.
And here we have today, the Russell 2000 is outperforming yet again. And to be quite honest, when you look at the technicals, it seems like the Russell could run a lot further from here. Now, we do have some things to go over that are pretty good for the Russell today and for the market breadth improving from here. We did hear from Fed Kashkari today. He had maybe some not so great things to say about where rates are, and I'll share that with you as well here in this video. But overall, it's a pretty good day for markets, especially small cap stocks. We also had some bad news for the AI sector, specifically Nvidia, that in a weird way could actually be benefiting small caps as well. So I actually want to share this with you guys. Tom Lee shared this on his X account. It's from Mark Newton. He is chief technical strategist at Fundstrat, the same company that Tom Lee also works for. And Mark Newton says, equal weighted S&P 500's breakout gives reason for optimism, as shown below. The act of the equal weighted S&P 500 regaining its 2-month downtrend along with rallying back above its late April highs is encouraging for the prospects of this rally getting more broad-based in the days and weeks to come. I feel like I've been pretty vocal about this here on the channel as well. I believe, again, I'll say it again, the NASDAQ and the S&P probably don't have that much upside left. And why I say that is because valuations are pretty high. You're really not getting discounts out there, and you're almost priced for perfection. Whereas small cap stocks are still down about 20% from just their all-time highs. Compare that to the NASDAQ, that besides this all-time high that you set in 2024, if you go back to 2021's all-time high, which you would do for the Russell, so in this comparison, we'll use that as well, the NASDAQ is still up almost 10% higher than your 2021 all-time highs. So really, the NASDAQ has outperformed the Russell by over 30% in recent years. Obviously, there has been a reason for that. Okay, that is obvious. The Fed was aggressively raising rates, and that it really didn't encourage anyone to invest in small caps. You also had small cap earnings that were under pressure. Now, the earnings picture gets a lot better on your comparisons, your year-over-year numbers, coming in the second half of this year. So Q3, Q4 should start to look better on a technical, more fundamental basis for small caps. But I think most importantly, it's actually the trajectory of rate cuts. Now, 10-year treasury yields, they're down about 5 basis points today. A couple different reasons for this. Well, investors are going out and they're buying treasuries. Now, there's not really a huge centralized catalyst for this. You did see the 3-year bond auction came in a little bit lower than expectations, and that was a big auction, so that definitely is having a positive impact to 10-year treasury yields today. But what this could actually be part of is maybe some of the unwind in stocks like Nvidia and some of your AI stocks today. Nvidia is currently down almost 2% today. Here you can see Stanley Druckenmiller cuts his stake in Nvidia and says AI is overhyped in the short term. This is the king who literally called the AI boom before anyone else, so his words tend to matter to the markets. Now, why this could be seen as maybe a positive for small caps and even for bonds for that matter is because a lot of money has pooled into Nvidia. It's pooled into the AI sector of our markets, and some of that money leaving Nvidia and other AI stocks, well, it could open up the door for other stocks to benefit from that. as long as the money's not all going in cash, in which it's probably not. And eventually you will see a dispersion of capital where high-flying stocks will start to underperform and small caps, interest rate sensitive names, average stocks, if you will start to do a lot better. Now, I don't know if we're exactly there yet, where you see this mass distribution of capital or redistribution of capital out of AI, out of NVIDIA, out of your high-flying tech stocks into other random stocks. I don't think you're quite there yet, but I think you're getting closer and closer by the day. Something else I would like to point out is the probabilities for the first rate cut coming July 31st are improving. So this is really what you want to be watching for, is July 31st, 2024. Over here on investing.com/Fed Rate Monitor tool, you can look at June 12th as well. There's still 5 weeks until June 12th, and there's always a chance that the Fed may end up cutting rates in June. But that would really be counting on a super good inflation number coming out, maybe a deflationary inflation number coming out, and maybe the economy getting a lot weaker from here. I don't know if that's going to be my base case, so I don't think we're going to get any change from the Fed coming June 12th. But what I do think is we get our first cut coming July 31st. Now, this is the reason why I believe you'll likely see a rally in small cap stocks and equal weighted S&P, as Fundstrat says, right? As Mark Newman says with Fundstrat. Because I do think over the next coming weeks, the markets will start to price in the first cut in July, as inflation does come in lower than expected in the next CPI report. I hope it does. And you do see maybe a labor market that's not collapsing, but definitely not as strong as it once was. And part of the reason for the outperformance in the Russell today is you're seeing exactly that. So on Friday, there was 29.2% odds of a cut July 31st. Today, the odds are 31.9%. So they're actually rising almost 3% today in favor of a cut for July. I actually believe you're going to get a cut July 31st, September 18th, and likely December 18th. So I still think you'll probably get 3 rate cuts this year, although that is uncertain. I think there's a strong reason to believe July 31st could be the first cut, and there is about 3 months. Don't get me wrong, about 3 months before we get that July 31st Fed meeting. But I do think the markets are going to start pricing that in ahead of time. Within the next month and a half or so, you could likely see markets, start to bid up small caps and interest rate sensitive stocks. Now, this is also something Tom Lee shared on his X account with eyeball emojis and pointing to this chart. So this is a chart of commodity prices and the 10-year Treasury bond yield. So you're basically looking at here in right the 10-year Treasury yield, and in the left here in this blue line, you're looking at commodity prices, the commodity price index. Now, commodities are an input cost. So if we're thinking about inflation, there's really 3 things that affect inflation. There is demand. If people have jobs and they have money and there's products you have to buy, well, obviously that can be inducive to inflation. There is commodities, the raw material cost that companies need to purchase to make their products and services. That's an input cost, inflationary potential pressure, right? Commodities do tend to fall over time, and that's why goods inflation tends to fall over time. There's a longer topic of conversation you could get into when it comes down to commodities, but that is an input cost to inflation. The third of which is kind of self-fulfilling to the strong demand in people having jobs, and that is wages. So you're thinking about all of these things in the business cycle that create inflation. It is wages, it is input cost, most notably commodities, and what determines really the price of these 2 things is overall demand and labor. Because if people lose their jobs for one reason or another, well, there's not as many commodities that need to be bought, so those prices tend to fall. And if people are losing their jobs, people tend to take jobs for less money, which is not really inflationary to average hourly earnings, okay? So really, in your, a modern economic theory, it's really jobs and the economy that dictates inflation. Now, that tends to circle back to commodities. Again, if everything's booming, then what tends to happen? You tend to get commodity prices that are stable, if not actually going up. Think about oil as a, well-known commodity that is volatile, that goes up with supply and demand, most notably demand. Well, this chart's basically showing you that the 10-year treasury yield is now falling, and what tends to happen is commodities follow the 10-year treasury yield. So as the 10-year treasury yield is falling, that's actually signaling that inflation or the economy may be getting worse from here. While inflation getting better, economy getting worse. Because what happens is big money, they go out and they buy bonds if they think the economy is getting worse or inflation is getting better. And that drops the yields. And what tends to happen is commodities follow that. And we have seen some very encouraging signs if you take a look at oil markets here recently. And we're looking at USO here. You've recently seen a spike, clearly, really all throughout 2024. To start 2024, oil was at about $65 a barrel. And then just recently, as of April 12th, oil hit $83 a barrel. Now, it's at $75 a barrel again. Oil is a huge input cost. Not just, I know people get kind of lost in the sauce here, if you will, but oil is not just important if you're making plastic or selling car oil, whatever it is. Forget that. Oil is a huge input cost for shipping. That's the big part. Whether you're shipping freight containers across the ocean, whether you're shipping things in a FedEx plane, if you're not making things at your home, anything that you touch, like these vitamin C tablets, like this Big B coffee, like this pacifier, I didn't make any of this. Oil was used to transport all of these things to the store in which I picked it up, unless I ordered it off Amazon, like these one-a-day vitamins, okay? That's really the input cost that oil has. That's the inflationary pressure that oil has. And you're starting to get some better news, some better relief on that front. So upcoming inflation numbers could look a lot better. Thus, by July 31st, probably give the Fed a reason to start cutting rates. So really, in a nutshell, that's a good sign that inflation in coming months will start to fall again. Also, right at about the time you guys are watching this video, we are going to get earnings from Rivian, Arista, Upstart, Wynn, Lyft, Oxy, Twilio, Confluent, Toast, and Ashura Labs. Tomorrow morning, Uber, Shopify, Affirm, ACM Research, Avadel, Toyota, Emerson, and a couple other companies that really never heard of. There were some rumors that Apple is looking to potentially partner with Rivian that came out this morning, so that could be interesting. Arista Networks is seen as one of your AI trades. Just look at the chart. It's went pretty parabolic. Upstart, AI lending, really not that important for markets at all. Nobody's really going to care, but it can move a lot. Wynn Resorts can be important to see just how the consumer is doing. Lyft, Uber's kind of stealing their lunch, so it doesn't really matter there. Twilio, kind of seen as maybe an AI stock, but not really. So not too many big earnings today. Tomorrow's the big day. Shopify can be important for Amazon, and again, the state of the consumer. Same is true with Affirm, and then obviously with Uber. Tomorrow and after hours, that's your big dog with ARM. ARM will directly have a sympathy reaction to NVIDIA. I doubt it'll have much of an impact to AMD, SMCI, Intel, or any of the other AI semiconductors that have already reported earnings. One, because they've already reported earnings, and it's no surprise what their numbers were, and NVIDIA has not reported yet, but NVIDIA tried to literally buy ARM. They do a lot of business together. NVIDIA is by far ARM's biggest customer. So if ARM has bad earnings or misses expectations, that's not going to look great for NVIDIA before they report. Again, as you're seeing today, NVIDIA is down 2%. You still have IWM up almost 0.5%. So depending on where you're allocated in our markets, you don't really need to see NVIDIA doing well per se for small caps and for the Russell to do well. The percent of stocks above their 50-day moving average today is hitting about 55%. That means 55% of stocks out there on the markets are trading above their 50-day moving average. That's a pretty decent number, still kind of on the low side. It's not like you're seeing a huge broad-based rally, but considering we were just as low as 25%, that's pretty good. You're getting a better broad-based participation in the markets now than you were over the last couple of weeks. Here today, 2.1% of all stocks are going above their 50-day moving average today. So that's pretty good. CNN's Fear and Greed Index today sits at 38. So believe it or not, yesterday you were at 40. Even though small caps are outperforming, even though the NASDAQ slightly down today, not a huge deal in the grand scope of things, investors are getting a little bit more fearful today than they were yesterday. And there is 7 different indicators to the fear and greed number. You have market momentum, that is considered in greed territory. Stock price strength is extreme fear. So that means there's not a lot of participation in the markets. And when the markets are having up days, there's not a lot of stocks going up. When the markets are having down days, there's a lot of stocks that are going down. Stock price breadth, same thing there. You are in fearful territory, not a lot of stocks participating. Put and call option activity is hitting fearful. Yesterday, this was neutral. So a little bit more puts being bought today on our markets, which could be a troubling sign for what is ahead. Market volatility is considered neutral, and that is the VIX and its 50-day moving average. Safe haven demand is in extreme fear territory. This is the difference in the 20-day stock and bond returns. So bonds outperforming stocks. When bonds outperform stocks, that means there's more money going into bonds. When money goes into bonds, as I explained previously, that is seen as a safe haven trade. And then you have junk bond demand versus investment grade demand, and that is in greed territory. And last but not least, if you take a look at the technicals for the NASDAQ, yesterday you gapped, well, it wasn't a huge gap, but a slight gap up above your 50-day moving average. And you did have an over 1% positive day yesterday. You continued higher today, and then you got rejected at about 442 on the NASDAQ. Now you're down to under 440. Not great, but not bad as well. If we do get downside, that 50-day moving average is likely to serve as support. If it doesn't, then you're in for larger downside. I think whether or not the markets go up or down from here largely depends on ARM earnings coming out tomorrow in after hours, because we just don't have a lot of data. And by the way, before I forget, I do want to share with you the quotes from Kashkari today. How could I almost forget? Because this is definitely going to have an impact on our markets as well. Fed Kashkari says the most likely scenario is we stay put for an extended period on rates. He says, in March, I jotted down 2 rate cuts for this year. It is possible that that will stay at 2 or go to 1 or 0 rate cuts for the June SEP. Fed Kashkari says if inflation becomes embedded, we may hike if needed. And last but not least, Fed Kashkari says, I would need to see multiple readings on inflation to be confident to cut rates. I don't think this is having much of an impact on the markets today, because Fed Kashkari said that like 2.5 hours ago, and it didn't move stocks much. Now you're seeing a little bit more of that downside volatility coming into markets. Maybe some of the quotes from Kashkari are being digested a little bit, interpreted a little bit more, but I don't really think that's having a big impact on the markets, but it wouldn't surprise me if it does. Again, I will say it for like the 10th time in 2 weeks. I don't think there's a lot of upside left in the NASDAQ. So it wouldn't surprise me if we do trade in this range of, 440 to 400 on the NASDAQ. Honestly, it wouldn't surprise me if we did go lower than your April 19th lows, especially if NVIDIA does, let's say, miss on earnings coming here in about 2 weeks. That is definitely on the table. But again, I don't think IWM necessarily needs NVIDIA to do well. I think IWM is going to have, Russell is going to have some positive things going for it, with the first rate cut coming July 31st, in my opinion, and with an overall dispersion of capital out of big tech, that could also serve as a positive catalyst for the small caps. So for those reasons, I'm very bullish on small caps relative to the NASDAQ. Now, if we start to go into a recession, if recession fears start to come about, then I'm not going to be bullish on the Russell anymore. Okay, I'm not going to be bullish on anything. But until we get data that definitively says, hey, we may be going into a recession, then I think you probably want to be more bullish on small caps than the NASDAQ, solely based on valuation and participation. You've had a lot more participation in this rally that really years now from the NASDAQ. And I do think the Russell, you could actually see a catch up in performance wise in just a couple of weeks. You could see a 10+%, 20%-ish rally in the Russell. Give us the right news in 2 to 3 weeks time. Not from here, but when that news comes, 2 to 3 weeks time frame, you could see a 20+% rally in the Russell when things do start to flip. And that's something I want to be prepared for. And that's how I'm currently allocating my portfolio. So nonetheless, let me know what you think about this information down below in the comments section. Again, I want to give you guys a brief rundown before we wrap up this video of what we have in store for tomorrow, and it's really not much. So for May 8th, coming tomorrow morning, some oil data coming out in the morning at about 9:30 in the morning. Fed Jefferson speaks at 10 a.m. Fed Collins speaks at 10:45 a.m. The biggest event likely tomorrow is the 10-year bond auction. You can see here the last yield was 4.56%. If that comes in higher, that's a problem. If it comes in lower, that's good for markets. 10-year bond auctions specifically are important because they do directly affect the 10-year treasury yield. Go figure, right? And then Fed Cook will speak at about 12:30 p.m. tomorrow. But that's it. At 10 p.m. tomorrow night, Eastern Standard Time, you will get the balance of trade coming out for China. But that's it for tomorrow. So again, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.